In Indian households, gold has a clearly defined role. It acts as the ultimate reliable safety net for a family, the Sankat Ka Sathi. Physical gold serves as an enduring financial shield when crises hit. Families buy it, they lock it away, and trust that the value will hold no matter what happens to the broader economy. But at the national level, this exact household security created a deep economic vulnerability. India imports almost all of its gold. As millions of families bought physical metal, massive amounts of foreign exchange reserves drained out of the country to pay for it. The cultural reliance on physical gold placed severe pressure on India's current account deficit. The state needed an intervention that would respect the domestic demand for gold while stopping the drain on foreign currency. The solution was a concept known as paper gold. The idea was to offer citizens the financial returns of gold without the need to hold physical metal, completely eliminating the risk of locker theft. This became the sovereign gold bond scheme. The mechanics were simple. You hand the government cash, and they issue you an official paper certificate tied directly to the market value of gold. As an added incentive, the government offered a 2.5% annual interest reward on top of it. The launch saw massive adoption. Millions of citizens trusted the scheme, allowing the government to raise 72,274 crore rupees across 67 separate tranches. At its inception, this appeared to be a flawless policy. Citizens secured guaranteed returns backed by the state, and the government successfully curbed the massive physical import of gold. When the bonds were first issued in 2015, the baseline math seemed safe. Gold was trading around 2,600 rupees per gram, and policymakers assumed prices would remain relatively stable over the bond's 8-year maturity period. That assumption collapsed. Over those 8 years, global forces pushed the price of gold aggressively upward, hitting massive peaks above 14,400 rupees per gram. Think of it like borrowing money from a friend. If you borrow 2,600 rupees and promise to pay back whatever that same gram of gold is worth 8 years later, you now owe 14,400 rupees. The terms didn't change, but the market value did. This chart shows the percentage of global central banks planning to increase their gold holdings. It reveals an overwhelming institutional demand that explains why the price spiked so drastically. Central banks across the globe began aggressively locking away physical gold reserves, seeking hard assets to protect their national economies against rising geopolitical instability. China became a major driver of this trend. The People's Bank of China bought record amounts of physical gold to systematically build reserves and shield themselves against the threat of U.S. sanctions. These global geopolitical fears and the subsequent central bank hoarding directly inflated the price of gold, drastically multiplying the financial burden of India's domestic policy. Applying that household borrowing math to the national scale reveals a steep imbalance. The government originally raised 72,274 crore rupees. Today, the redemption exposure on those outstanding bonds is estimated at roughly 1.87 lakh crore rupees, 2.6 times the borrowed amount. The government officially decided to bear this price volatility itself. When designing the scheme, policymakers explicitly chose not to hedge the position, stating in their documentation that all risks associated with the gold price would be absorbed by the state. The safety net designed to absorb those risks was called the Gold Reserve Fund. It was set up like a household's bachat fund, an emergency jar to cover unexpected redemption costs. Today, that safety net is depleted. Against a current estimated liability of 1.87 lakh crore, the Gold Reserve Fund has shrunk to just 697 crore. The state is now managing one of its largest commodity-linked financial obligations with virtually no dedicated reserve fund left to absorb the impact. If the government owes an additional 1.15 lakh crore due to gold appreciation, it raises a critical question. Why isn't Parliament sounding the alarm over a massive spike in the fiscal deficit? India records these transactions through cash basis accounting, a system that functions like a traditional bahi khata or household diary. The budget documents record the bonds strictly at their historical issue price of 2,600 rupees, omitting the real-time market value surging past 14,400 rupees. Modern accounting standards that would mandate this mark-to-market disclosure actually exist. A standard known as IGAS 10 was approved specifically for public debt disclosure, but it has never been legally notified or enforced by the government. This reporting method reflects a structural governance gap, a blind spot maintained by outdated financial rules rather than active corruption. Because the standard remains unnotified, the escalating cost of the sovereign gold bond scheme remains legally invisible to the public and to Parliament, masking the actual weight of the sovereign debt. The policy resulted in a striking irony. The sovereign gold bond scheme delivered a fantastic tax-free financial win for everyday retail investors, but maintaining it became far too expensive for the sovereign. Facing this escalating unhedged cost, the Ministry of Finance made a quiet administrative decision. They completely halted the issuance of new SGB tranches for the 2024-25 fiscal year. While the new issuances have stopped, the financial obligation from the past remains. A massive wave of impending debt is silently approaching the national accounts. The critical question moving forward is how the country will manage the immense cash outflow when the bulk of these mature bonds hit their redemption window between 2027 and 2032. What began as a creative fix for a currency drain has evolved into a multi-billion-dollar weight on the national balance sheet. Understanding these hidden questions is the first step in analyzing the full scope of India's golden gamble.